In this video, we will talk about Texas Pacific Land, TPL, because the stock has dropped a lot. I think the stock is on a 50% drawdown. As I'm recording this video, the stock is below $900, and it's been a while since we've seen this kind of number, this kind of price, like 1 year ago. So you have to go back to September 2024 to have this kind of prices. And if I check the drawdown of the stock, we are 50% below all-time highs. This is not the first time it happens. Let me show you a couple of websites. This is not the first time it happens. Look at this in red. This is the drawdowns the company had. I can even check since the 90s. You had 1, let's say 2, 3, 4, 5, 6, 7. It's the 7th time we have a big drawdown for TPL. So what will we do in this video? In this video, we'll talk about the price action, why the stock is trending down. I will talk about the financials of the company because they recently reported the earnings, a quarterly report which was very good, I would say. And we'll talk about the valuation, and I will do a DCF, and I will tell you the price at which I'm buying TPL. Because now I start to see some YouTube videos, people mentioning the stock, people start to catch the knife, as we say, so you will know everything about TPL. Full disclosure, this is not the first time I'm studying TPL. I've been a shareholder for a while. I first bought TPL in 2020 and I held my shares for 4 years. It was almost a 10 bagger. So I first bought my shares, my TPL shares in 2020 when it was a hidden small cap, $4 billion market cap. And around here in November 2020. And I held, and I sold at the top. I sold, if my memory is correct, at $1,650. So around here, at the absolute top, because of a simple framework I've been using. So it was almost a 10x, a 10 bagger. And I sold because of valuation concerns. Basically, the stock was just trading at an expensive level. And since then, I've been waiting. And I've been covering TPL on my channel a lot because that's a very interesting business model. That's maybe my favorite business model of all times. This is a very, very good business. It is just about valuation at this point. So I don't know why the mic is disappearing. So be it. Let it disappear. And I think we can start. I've received a lot of comments under my videos about TPL. Why is TPL falling? When will it rebound? Well, if people knew this, they would have a crystal ball, and nobody knows if the downfall will continue for TPL. Let me get you some first point in this video. The stock right now is trading at a reasonable valuation or a little bit expensive valuation. We have a PE ratio of 40, forward PE ratio of 35. So let me start straight up saying the stock is not cheap. It can continue to go down. And if you look at the valuation for TPL over the past 20 years, 30 years, well, we are not at the cheap territory. So yeah, I think we will cover a lot of ground in this video. Take a cup of coffee, take a cup of tea, and I think we can start digging now. In case this is your first video from this channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. Thanks to TPL, by the way. Thanks to TPL and all other quality stocks, quality companies that I've been holding so far. And I want to see the PE ratio of TPL. You will see over the past 20 years what the PE ratio looks like. If I'm showing you this graph, can you tell me if the stock is cheap or not? People say, yeah, the stock is falling drastically. The stock is falling by 50%. Yeah, but it's falling 50% from a very high multiple. Look at this. When the stock was at the peak, the PE ratio was 80. So you can get cut in half and you will have a PE ratio of 40. Is 40 reasonable for this kind of stock? Well, over the past 20 years, the PE ratio has oscillated between, the minimum point was 9, but let's say it was a COVID event, so quite a special event. But let's say the minimum PE ratio is 15 and the maximum is 80. And you see over the past 20 years, the stock has oscillated between 15, what's that? 60, 15, 40, 20, 50, 15, 70, 15, 80, 25, 80, and now we are back to 40. My strong guess is it will go down again. And this is the reason why I'm not buying. So here is the answer from the first questions. The stock goes down because of valuation concerns, and I am still not buying the stock because I am not biased because the stock is in a downfall of 50%. Okay, so it doesn't mean anything for me that the stock is falling 50%. The price action means nothing. It's all about valuation. We are a YouTube channel about serious investors. We are not lured by the stock prices. We care about valuations, right? And valuation speaking, the stock is not cheap. Okay, so I wanted to start this video by showing you this big chart, which is maybe the most important chart for TPL. All the fundamentals are fine, but a lot of people asked, is this cheap enough? This is a French comment. Is this cheap enough? What do you think of TPL now? Looking forward to your TPL analysis. TPL is close. People are really impatient to look at TPL, impatient to buy TPL. Another advice I can give you is, please be more patient. You will have your time. See how cyclical the stock is. It goes up, it goes down. I bought TPL at 2 instances in the past. One in October 2020 at a PE ratio of 18. And a second time in June, July 2023. So that should be around here at a PE ratio of 25, 27. Only 2 occasions that resulted in a 10-bagger, almost a 10-bagger. You need to be patient in this game of investing to have the kind of results you deserve. If you're impatient, you will have mediocre results. And in the meantime, what will you do? Well, you can buy other companies. I've been buying other stuff in the waiting time, meanwhile. So now what I want to do is talk about the valuation, talk about the growth rates, talk about the most recent earnings report, and we'll talk about the DCF and the future growth assumptions, okay? So we've talked about the price action, we've talked about the valuation. The stock is not cheap, but the stock is still firing on all cylinders. If you look at the performance of the company overall, the business is still profitable, still debt-free, still enjoying a lot of cash flows, and the growth rate is decent given that oil prices are low, I would say. If you look at the latest report, what can you see? You can see that in 2025, oil prices are down. Oil prices are low, let's say circa $60 per barrel. And Texas Pacific Land is a company linked with oil prices. If oil prices are high, TPL will make an excess cash flow, I would say, because they have lands in Texas. And if a lot of people drill oil, if the oil price is high, TPL will get a royalty. So in 2022, actually, TPL was very profitable back then. And since then, oil prices went down. You know what? Let me show you something. I want to show you the price of oil, and I want to compare this with the cash flows for TPL, because you will understand my point. Something that I've never seen anyone talk about on YouTube, and I will be the first. Okay, I can show you this. This is the oil price, okay? This is the Brent oil futures that went up massively in 2022 and now trending down. So it was almost cut in half from $120 to $60. Cut in half. Oil prices being cut in half. What about TPL? Did we have cash flows that were cut in half? I don't think so. I don't think so. Here is on a last 12 months basis. I'm using Fiscal AI to show you this. Here it is. At the time, I can look at quarterly. It would be even better. At the time, even in March 2022, at peak oil prices, you had operating cash flows on a quarterly basis of $100 million. Now, oil prices were cut in half and cash flows continued to increase. What is happening over there? I thought that TPL was an oil and gas play. A lot of people, including the Morningstar reports, including a lot of financial websites, consider that TPL is an oil and gas play. I strongly disagree here. It's linked with oil prices, yes, but it's a land management play. And if you smooth things out on a last 12 months basis, you see that it has plateaued during 2023, 2024, when oil prices went down and down and down and down. The cash flows for TPL were stable. Because at the same time that oil prices went down, you had more productions, more volume, more drilling. This is a volumes games. And over the past 3 years, since 2022, TPL has gotten much more efficient when it comes to their land management. How much drilling do you have on their lands? And now TPL can generate more operating cash flows compared to 2022, despite lower oil prices. If that doesn't tell you the strength of the business, I don't know what will. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. What if oil prices rebound from there and you go from $60 to $70 per barrel or $80 per barrel? We were there at the beginning of 2025. We were there in 2024 above $80. It can happen. What if oil prices go higher? With TPL being more efficient than ever, with more production, more volume, more efficiency everywhere. I think TPL is very well prepared in case oil prices go up again. So now, if oil prices stay down, TPL can sustainably manage operating cash flow of $500 million, I would say. $500 million, like they've been doing so. And if the stock price if the market cap is $20 billion, you can get, you have here the price to operating cash flow of 40. So a little bit expensive, I would say. What if oil prices go up from there? You can have a business that can generate $800 million in operating cash flows. And that would be extremely bullish. And nobody's talking about this one on YouTube. This is very big, actually, to have an oil and gas play that is getting better and more efficient. At the same time, oil prices are lower. It is getting quite interesting. So now, free cash flow will be impacted on some websites because they've done some acquisitions. I want to show you the investor relations, the report, and see what we have here. Realized price oil at $60 a barrel. Okay, fair enough. Compared to last year when it was higher. Let me show you the presentation. It will be even easier to understand. What I want to show you is the business is still growing like 10% per year. Even at the same time, oil prices are getting lower and lower. So here is the investor presentation for August 2025 for TPL. Okay, let's see. We have a business model with more royalty production, with more produced water royalty volumes, and at the same time you have lower oil prices. Okay, this is basically it. If you look at the revenue of the business, if you compare quarter over quarter, Q2 2025 against Q2 2024, now we have generated $187 million of revenue. You can compare this to $172 million. That's a growth rate of roughly 9%. So oil prices are down, but at the same time, I mean, oil prices are down from $80 a barrel to $60 a barrel. At the same time, revenue is going up by 9-10%. See how profitable the business is. It's all about production right now. Water service. Yeah, water is still fine. Water is still fine. Let me show you what we have on the investor presentation. You have the land and resource management that is still holding up very well. And at the same time, you have the water services in full force. In 2016, 2017, TPL went into the water business. It's a more capital intensive business, but it's growing massively, and it has a lot of potential in the future, especially in the Texas region. Now, maybe you have seen some articles on the internet saying that Texas desperately needs more water management. And companies like TPL and Landbridge will be at this bottleneck and will benefit from this situation of drought in Texas. The need for water is just immense in Texas. And these two companies will be here to help the region. Okay, what do you have? Key takeaways: no debt, 100% Permian exposure. Let me continue. That's the market cap. This is net cash. Adjusted EBITDA is still strong at all-time highs. Free cash flow is at all-time highs. Fair enough. This is the evolution of the company. You have a lot of return of capital throughout dividends and share repurchases. Yeah, if you are looking into TPL right now, you may have some questions when it comes to management. And these are good questions to have. The management team for TPL is, let's say, not great. The management team for TPL has been accused of all the names, all the words. The management team of TPL has gone into a court, a trial with their biggest shareholders in 2023. This is the reason why the stock dropped significantly in 2023. It was a court time, trial time. And at the time, the biggest expense of TPL was the lawyer cost for the trial. Nobody knows this, nobody talks about this, but you can go back to the reports at the time, and it was a very scary time to be invested in TPL because of the horrendous things we learned about management. And I will not talk about this on this video. You have to do the work. So maybe for another video, but this is not the topic of this video, right? So you want to buy TPL when it is very scary to invest in TPL. Now it seems like people are not scared enough. You have a PE ratio of 40. People just don't care about all the qualitative aspect of the investment, and they just think that the stock is down by a lot, so it must be cheap. I am following a lot of investors, professional investors that are invested in TPL. Almost everybody sold at the same timing when I sold, at the peak valuation at the end of 2024. And nobody has entered back again. So what I'm saying is a lot of professional investors are still waiting. The only guys that are buying are retail investors at the moment. So maybe this is quite telling. I mean, you do whatever you want with this information, but I'm still not buying. Let me scroll down on the investor presentation, see if we have some value. And after this, we'll go to the DCF and I will tell you my buy price. Invest capital. I wanted to talk about the capital allocation decisions and management teams because over the past life for TPL has been very focused on buybacks. And Horizon Kinetics, their biggest shareholder, they own like 20 or 30% of the business. They were pushing buybacks heavily, enticing the TPL management team to do as much buybacks as they want. And as the valuation went up, the management team stopped the buyback program and they favored dividends. I do not like this. Let's say I strongly disagree on the management team here, but this is not a reason not to be invested still, because the business model is so good that even a simple man could run it. They have a few employees, TPL has been operating since 1888, the business will be fine. So the management team is not very great at capital allocation. They want to make stupid acquisitions. They want to dilute shareholders. They want to do a lot of M&A and diversify away from their core segments. And hopefully for us, potential investors, we have Horizon Kinetics that will save the day. If you look at the insider ownership on Fiscal AI, you click on ownership here, holders, you see the biggest shareholder is a fund called Horizon Kinetics from Murray Stoll, and they own 15% of the company. But this is their flagship fund, right? You have another fund here, they own an additional 3%. That should be it. You have a little bit more than this. You have the inflation beneficiaries, Horizon Kinetics fund also. Anyway, you have more than 20% insider ownership, and they are very vocal about their TPL position. And for Horizon Kinetics, TPL is 50% of their portfolio. So that's a lot, 50%. Now the stock has dropped, so maybe it's a little bit less than this. So it's been their main position for a while, and they want to do buybacks for the very long term. And they don't like dividends. If the stock is trading at an expensive price, just wait. Don't do any dividends. Just wait when it is becoming low again, when the valuation is low, and just do some more buybacks when the stock is low. And again, if you don't know how to understand capital allocation decisions and buybacks, I've made some videos on my channel about when it is smart to do buybacks. Basically, you want to increase the buyback programs when the stock is trading cheaply. And when the stock is going expensively, like this at the end of 2024, it's a waste of value. It's a destruction of value to do buybacks here. It is not adding a lot of value to the earnings per share. So basically, the best case scenario would be when the stock is cheap, the company does a lot of buybacks. When the stock is expensive, they stop. They just stop. They don't focus on dividends. I would say this business is cyclical, so maybe you want to stop because you know one day or later the business will be cheap again. So save your cash, wait 2 years, and then you can start the buyback program again. Now, if the stock continues to drop, I would be very happy to see the management buying back their own shares. Guess what? Now they are doing almost zero buybacks. The stock is dropping. They have used all their cash to do dividends. So yeah, this is the situation we have. But still, you have zero debt. You have some cash, and the free cash flow is trending up very well. This is a very good asset. Landbridge is here. You still have a business with extremely high margins. And even with the development of the company right now, with the competition, with the oil prices being low, TPL is still my favorite business of all time. And don't worry, guys, I will tell you what I'm buying. Water sales. What is great is water sales are trending up at 20% per year. If you go to Fiscal AI, you go to financials, you go to segment and KPIs, you look at water sales or produce water would be even better. You look at this performance and you see that this trend is up and to the right and having a CAGR of 18%. So this segment, produced water royalties, is going up by 20% per year. Very, very bullish if you want to cross-read this towards Landbridge, for example. So we know that the water segment for TPL is growing at 20% per year, both for the water sales and produced water royalties. So the water segment for TPL is growing at 20% per year. Very, very bullish for another company in the Texas area called Landbridge that is solely focused on water. No oil and gas, no nothing, solely water. So Landbridge has the potential to grow 18-20% per year because of this. And this is a newer business with better margins. So maybe it will be very interesting. I created a custom metric for TPL to understand the margins for water and the margins for oil. And here are the margins. This is the net income margin. For oil and gas segment, you have a net income margin of 60-70%. Okay. And for the water segment, I told you it was less profitable, but you still have a net income margin of 50%. Can you name 10 businesses with a net income margin of 50%? You will have Visa, MasterCard, MSCI, these kind of things, but you don't have maybe 10. It will be very hard to find these kind of businesses. And at the same time, you have these very high margins coupled with lower oil prices right now. So this is not the most efficient TPL you can get. What if oil prices go higher? You will have a lot more efficiencies and margins will go at a sky high level. This is my opinion. Let me continue. I think we'll go to the DCF now. Now that we've covered the investor presentation, the business is fine. The business is still growing. Even if oil prices are down, the business is still growing 9 or 10% per year. You have much more production, and I think TPL will be the main beneficiary if you have maybe geopolitical conflicts. If oil prices go up again, TPL will be my number one buy. In case we have a shock, a geopolitical shock, I will not buy oil majors, Chevron, ExxonMobil. I will just buy TPL. That will be it. And that's my hedge. So if you look at the metrics for TPL, everything is still going in the right direction. Growth has slowed down. That's normal. But what about the DCF? Over the past 5 years, the free cash flow is down because the stock unlock is bugging for TPL. Just a full disclosure, let me do a quick parenthesis here. The free cash flow, it looks like it is dropping by a lot because stock unlock has a problem. They took into account the acquisitions and they counted the acquisitions as capex. So the free cash flow is wrong for stock unlock. I love stock unlock, but this is a bug, a simple bug. If you want to know the free cash flow for TPL, I suggest you go to Fiscal AI. That's why the two websites are complementary. By the way, if you want discounts for both these great websites, you have links in my description, like minus 15% off for Stock Unlock and for Fiscal AI. This is great. I mean, minus 10%, minus 15%. I have affiliate links so that it's getting cheaper for you. Look at this, purchase plan equipment. This is the capex for TPL. No change, okay? And the big things that are changing are here. Intangible assets, acquisitions. They made 2 acquisitions of royalties, and I'm not a fan at all about these developments, but so be it. So they made 2 acquisitions, and Stock Unlock is counting this as free cash flow. So they say the free cash flow is dropping like a rock. Well, if you want the accurate free cash flow, you just go to Fiscal AI, and here we go. It is not dropping like a rock. If you smooth things out, it is at all-time highs. Okay, so now that we have covered this point, I mean, I could put 500 here. You have 2 ways of doing the DCF. Either you take the last 12 months and you say, I don't know if you're following here. If you look at the last 12 months for the free cash flow on Fiscal AI, you have this last candle of $500 million. So overall, we can say that the business can generate, at current state of the market, $500 million in free cash flow. So on the DCF, you put most recent metric and you put the free cash flow basis for 2025 of $500 million. Okay. What is the growth rate of free cash flow? Since 2020, well, the free cash flow has grown at 22% per year. It was not always like this, guys. I don't want to be biased or something like this. If you want to know the growth rate of the free cash flow, you have to go back to back in the days. I would say the business accelerated a lot since 2017. Free cash flow is here. Very well. For the past 20 years, the business has grown their free cash flow by 20% per year. But everything has accelerated since 2017 with a CAGR of 30% per year. So maybe you don't want to be too optimistic. Maybe 20% per year is a little bit too optimistic, but it's still possible. So I would say let's put a growth rate of 15% per year for the free cash flow, okay? At the same time, we assume no dilution, no buybacks, no dividend growth rate, and a price to free cash flow of, now it will get interesting now. Price to free cash flow, obviously it will be at sky high valuations because, as I told you, the free cash flow is having a bug on stock unlock. But anyway, if you look at the price to free cash flow, that's very similar to the PE ratio, price earnings ratio, oscillating between 15 and 60. 15 and 60. 25 and 100. I was selling TPL at these high valuations, like a price to free cash flow of 90. The average, the median is around 35. So what if you put a price to free cash flow of 35 on your DCF? If you put 35 on your DCF, you have a business that is at fair value. And if you buy right now with given assumptions, you can generate a CAGR of 12%. Well, I'm not comfortable putting 30%. Maybe 30 would be more accurate. So that could be a little bit better. If these are your assumptions, you expect the business to grow at 15% per year for the next 5 years with the price to free cash flow of 30, then the business is fairly valued. A little bit overvalued, but let's say fairly valued. And you can expect a CAGR of 9%. Are you happy with the performance of 9% going forward? Well, if you want to find the multi-baggers and outperform the market, I would not say this is a good risk-adjusted investment right there. What if the business grows 20% per year? In this case, that's way better. You can expect 13% per year. Okay, so that was for the free cash flow part. And what if the business grows at 10% per year? The free cash flow, that's a CAGR of 4%. Yeah, if you are taking the bear case scenario of only growing 10% per year, well, you will be flat, which is not what you want. So now let's do the same about earnings. Same thing if you expect earnings to grow at 15% per year and you expect the PE ratio to be at 30. If you think this is what will happen, you buy right now expecting a CAGR of 7%. Again, are you happy with this kind of performance? You are the one who can answer this question. I'm not the one giving you recommendations to buy or to sell. I'm just showing you the way. And the only way somebody could buy TPL right now is if someone would think they would grow 20% per year. And at given assumptions, this is a CAGR of 11%, 12%. I have the hubris of thinking I can do more than this, so I'm not buying at current prices. People that are buying right now think the P ratio will stay at 35 forever, growing at 20% forever. That's a little bit too bullish in my in my opinion. I would say if your assumptions are 15% per year and your PE ratio is 25, then you have good estimates. I would say this is what I think will happen between a PE ratio of 25 and 30. So if you want to take a screenshot of this, please do so. This is what I think will happen for TPL. You can have earnings, free cash flows that can grow at 15% per year. This would be my base case. In case oil doesn't rebound, oil fluctuates without a big rebound, in case nothing happens in the oil market, this is a business that can grow, let's say, around 15% per year. And for the PE ratio, I would say having a PE ratio between 25 and 30 could be reasonable. At a PE ratio of 25, the business is overvalued by 30%. And if you buy now at given assumptions, you can expect a CAGR of 3%. Very bad. Very bad. That's the same rate as inflation. If you expect the PE ratio to be at 30, in this case, the business is overvalued by 10%, and you can expect a CAGR of 7%. I would say anything above $800, I'm not buying. Now the business is still dropping below $1,000, below $900. What if it continues to drop below $800? Below $800, I would be monitoring the situation every day, and maybe I will start to buy. So anything below 800 would be interesting for me, but I would not go on a lump sum position for this one. I would not open the position. I would do several tranches of the position. That would be the base case, I would say, with the PE ratio between 25 and 30. But now it's just too expensive. I mean, if you buy now, you expect a CAGR of 7%. Not for me. Maybe for you, yes. But for the kind of outperforming I want to have in the future, that's a little bit too low, I would say. And what if we are on a bull thesis and oil rebounds and the earnings can grow at 20% per year? Unlikely, but anything can happen. In this case, if you buy right now, you expect a CAGR of 11% per year. Still too low, still not enough. Even if you have the bull case, a bullish scenario, it's still too high. It's just too high. The PE ratio needs to drop more. Now the PE ratio is at 40. Even if you look at the forward PE ratio, we are at an expensive valuation. I know what people will say. They will say that forward PE ratio. They will say that you have to take into account the lens, the value of the lens, to value this. And I will not do this. This is not the way I value TPL. I have never taken this into account, and so far so good. So now here is the forward price to free cash flow for the business. Even if you account the forward metrics, you have a price to free cash flow of 40. Still too expensive. Look at this in 2024, 1 year ago. I'm recording this video on August, middle of August. Middle of August, it was at 35. If you go back in time, May 2024, it was at 27, 28. I mean, anything below 30, be my guest. But now it's just too high, too high. People are frustrated right now, I understand, because the stock is down by 50%. We are enjoying a very large drawdown, and it is very painful for people that didn't sell at the top. But the stock is still not cheap, so I'm not buying. But I would say, starting a position at anything below 800. So I think we covered a lot of ground on this video. I will update you on my position if I buy in coming weeks. I just hope the business continues to improve, and I just hope the stock continues to drop and drop and drop. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description, and I'll see you on the other side.